Hello and welcome to Market Domination. I'm Josh Lipton alongside Akiko Fujita, live from our NYC headquarters. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
We're going to send all the federal resources they need as we respond to this emergency. And I mean all the federal resources. And we're going to rebuild that port together. We're incredibly grateful for the brave rescuers who immediately rushed to the scene, and to the people of Baltimore who want to say, we're with you. We're going to stay with you as long as it takes. And like the governor said, you're Maryland tough, you're Baltimore strong, and we're going to get through this together. And I promise we're not leaving.
Historically, very few occasions, but historically, when there has been a soft landing and you combine that with rate cuts, that has been the best foundations for the equity market and for broader risk assets as well. So if that does play through, even if it's just 3 rate cuts, it's a fairly good story to have.
You've got huge backlogs, a lot of demand from customers, but you've got a company that's struggling post-pandemic to produce aircraft in the way that it should. And so they've got some things that they've got to fix, and part of that process, I think, is going to be bringing in some new management.
We've got 1 hour to go until the market close here, and taking a look at the major indexes. Akiko, we've got some green arrows here, just some basically modest gains for your major averages. You can see the Dow's up about 0.2%. Tech-heavy Nasdaq is up about 0.3%, and the S&P 500 up about 0.2% as well. We did get some economic data as well today. You saw consumer confidence. That was little changed in March, basically remained steady. Durable goods orders, though, they actually rebounded about 1.4%. The bottom line here is this market just continues to want to grind higher with no real turbulence. The SPX, the S&P 500, is now on track for its best first quarter since 2019. Now over to Akiko for a stock name we are watching.
That's right, Josh. Former President Trump's social media company Truth Social surging more than 30% in its first day of trading. Now we're talking about more than 40% with about an hour left to go in the trading day here. DJT is the ticker symbol that we're looking at here. More than 6.5 million shares changing hands here by 9:50 this morning. So certainly getting a lot of attention among investors. The SEC filing showing former president has roughly 70% share in the company. But worth reminding our viewers, Josh, company reported less than $3.5 million in revenue.
That's what's impressive. So it's a market valuation, Kiko. I just checked. It was around $2.5 billion for a company that in the first 9 months of last year reported around $3 million in revenue. That's million, folks. That's not billion, million. So I don't know, maybe the bet here, what do you think? Like Trump wins, they take market share,
well, that's
make a profit?
That's the thinking. And either way, it's going to be in focus, right, between now and November.
For sure.
You know the former president's going to be taking to Truth Social to get his message out. So huge pop, at least, on the first day of DJT. Well, stocks moving higher today as markets look to continue the record-setting run to start the year. And with inflation cooling, the labor market solidifying and the economy expanding, our first guest today says that as Q1 comes to a close, the soft landing narrative remains intact. Let's welcome in State Street Global Advisors Chief Investment Strategist Michael Aroni. Michael, good to talk to you. We've seen a number of firms really up their S&P 500 targets given the run-up that we have seen so far. Where do you stand on that right now?
So it is hard to bet against stocks at this moment. As you mentioned, the economy continues to expand, the labor market's in good shape, inflation's moderating, earnings are growing, and consumers are spending. That is a formula for risk assets to continue to do well. The only thing I would highlight, Akiko, is that with valuations where they are and markets at all-time highs, I do think that the risks are likely skewed to the downside. It's just hard to envision what is that risk today. Perhaps it's the Fed remaining too restrictive for too long and slowing the economy more than expected.
What about Michael's sentiment? You know, that's another kind of variable some strategists have flagged to us on the show. They're looking at those surveys, Michael, and maybe it's too many people on one side of the boat. How much weight do you give sentiment?
Josh, it's interesting. Just before I got on air, I checked out the AAII survey. I had to do that really slowly. But from my perspective, what was interesting is the bullish sentiment's around 43%. On average, it's around 37%. And both neutral and bearish they were kind of in line with historical kind of averages on those figures. So to me, when I'm meeting with investors, they continue to be fairly skeptical of this rally. You mentioned in your opening around the consumer confidence today. So people feel really good about where the economy is today, consumers, yet 6 months out, they're a bit anxious. Well, that wall of worry could feed further into this market rally. So I think there's still, despite some views that sentiment's kind of toppy, I actually think that there continues to be a fair amount of cash on the sidelines and a fair amount of skepticism, and that could drive this rally further.
Is this the time to put that cash to play now, though? Or Michael, you think you keep this cash on the sidelines given some of those potential headwinds you just highlighted?
Akiko, I think it matters kind of where you consider putting that cash to work. So certainly stocks and risk assets, I think, are positioned nicely for the balance of this year. However, if you were to give me some additional money, I'm not sure I would run right out and purchase the Magnificent Seven or kind of the top heavy market cap indices, given where valuations are, given where expectations are. However, if I look at things like cyclicals, small cap stocks, value stocks, there's actually some more valuation, kind of relative valuation opportunities there. And sure enough, one of the good things that's been happening in the last month is finally breadth is improving. Energy, materials, industrials, financials are now performing pretty strongly in the last month. That suggests to me that folks feel good about the economy. Inflation's a bit sticky. Some of those will benefit from higher inflation, but they're not envisioning a scenario where the economy enters recession. And so I think it's really those relative value opportunities that are a bit more interesting today than maybe the top heavy index or the Mag 7.
Michael, what if the Fed didn't cut at all this year? And listen, that's a possibility some pretty smart economists have raised. What would that mean for the market?
Josh, I thought it was really fascinating that coming into this year, investors were expecting 7 rate cuts. That's what the Fed funds futures told us. And yet the Fed itself said, hey, we're only prepared to do 3. That gap has been reconciled. And Josh, here we are. Markets are near or at all-time highs. It really hasn't had an impact. So to me, I think the biggest thing is not about, kind of how many rate cuts or when those might happen per se. It really is dependent on, is the economy still expanding while inflation's moderating? I think that's the key, and earnings still growing. That formula is fine and consumers in good shape. That formula is fine. I think it's those dynamics that pose the greatest risk, not whether the Fed does 1 cut, 2 cuts, no cuts. As long as the economy is expanding, I think, and earnings are growing, markets will be able to withstand no rate cuts from the Fed.
So, Michael, on that point, getting back to where I started the conversation, I mean, where do you expect the S&P 500 to track? We're looking at levels above 5,200 right now.
So it's interesting, Akiko. I think in the short term, you might see a little bit of a liquidity hiccup in April. So you have tax season coming up. There's going to be capital gains that need to be paid. As investors pay those capital gains, they withdraw funds from the financial system to pay Treasury, for example. That draws some liquidity. You have the bank term funding program that the Fed put in place for the banks back in March and April of last year. That's ending. You still have quantitative tightening, although the Fed has suggested that they may slow the process down or pause it. They haven't yet. So all of these things combine, at least in my opinion, to potentially have a little bit of a liquidity squeeze in April. But post-April, really, there's plenty of liquidity and plenty of fundamental kind of support for markets going forward.
Michael, always love having you on the show. Thanks so much for joining us.
Thank you.
We're just getting started here on market domination. Coming up, one analyst says it's time to bet big on sports gambling stocks. We're going to break down the top calls of the day on the other side. Plus, UPS getting hit hard today after unveiling its financial targets for the next 3 years. I'm catching up with the company's CFO later in the hour to discuss that outlook. And shares of Reddit building upon their IPO momentum. We're going to check in on the social media company as well as a few other trending tickers when market domination returns.
is still a really big one, even if you add additional incentives in there.
Yeah, although it is interesting, Kiko, hear Musk, and listen, we have Tesla bulls who will come on the show, and they'll pound the table on autonomous driving. I mean, you know that it's always one of their kind of like foundational arguments, why they're in the stock, why they kind of sort of justify the valuation, even though, as you know, for sure, recalls and also regulators, of course, carefully scrutinizing the software too.
Yeah, I mean, you have to wonder, is this something that Tesla wants to tout at this moment, given what has played out on the regulation side of things?
Yeah.
But
including, by the way, a high-profile trial about to start, too, involving a crash with the software. All right, we move on. McDonald's and Krispy Kreme announcing a sweet deal today. Get it? Sweet deal?
I knew there was a pun in there somewhere.
Expanding their partnership, the donut chain began selling at some McDonald's locations in 2022, but now the breakfast sweets will be rolling out nationwide in 2026. The fast food brand hope it will help further unlock further breakfast foot traffic and breakfast menu revenue. Let's bring in RJ Hadavi, head of analytical research. RJ, it's always good to have you here. I guess first of all, you know McDonald's very well, RJ. Just walk us through what you made of the news.
Hey, Josh, thanks for having me. I think it's interesting for McDonald's. I think what we've seen in the retail and restaurant space really the last year or so is these unique partnerships really driving a lot of traffic, whether it's McDonald's celebrity orders or other things like that. And this might be the next extension of that. I think we're seeing those chains that really are coming up with new menu innovation, new creativity, and even something as simple as a Krispy Kreme donut. That's something unique and gets people talking about it. That should drive traffic, potentially average ticket higher. So I think this is an interesting deal for them. I think that this could be one of many things, and it helps them not only recapture but retain a lot of the breakfast daypart traffic that they already command so much of. Yeah,
RJ, I mean, how big of a bump are they likely to get on something like this? It is, as you point out, it's about keeping the customer sort of in front with the menu innovations. I mean, this is just the very latest here. When you think about what McDonald's offerings are right now, I mean, how significant is this?
Yeah, when we go back and look at some of the other promotions that the company's run, some of the celebrity famous orders that they've done, or some of the other menu innovations, it's not unlikely to see, between a high single digit and a mid-teens lift in visitation trends compared to previous weeks. I think early on we could see certainly something like that. But I think part of this is it's more than just a kind of a one-time thing. I think this is innovation, but for long term. I think this is something that McDonald's doesn't really have much of mind share in donuts. I think this adds another product in the morning day part, and this is something they can extend and hopefully drive more visits. It has gotten more competitive at the breakfast day part. You're seeing other players like Wendy's get in the game. Taco Bell has done some things here. So it's a category that traditionally McDonald's has owned, but it's getting more competitive. And I think adding Krispy Kreme helps extend their leadership.
RJ, you look at McDonald's stock, it's in the red so far this year, RJ. It's up a whopping 2% over the past 12 months. What are just the catalysts ahead, RJ, that you think could maybe get investors excited about owning this name again?
Yeah, I think what we're looking at is growth, but not only just same-store sales growth, but also unit growth. The company's talked about opening new locations, which we really haven't done much in the U.S. in recent years. It's kind of been net neutral in terms of store openings. And so I think as we look to the Southeast market, particularly a lot of areas where we've seen migration, our data shows there's a lot of markets and a lot of white space now in the Southeast because of migration trends. That could get people excited, not only just the traditional kind of same-store sales growth, but they might add a more of a growth component that we really haven't seen from McDonald's in a couple of years. Not only unit growth, but I think some of the innovations they have across not just the breakfast day part, but lunch and dinner as well. All these things could add up and start to add to a really compelling growth story compared to particularly the rest of the QSR sector. Obviously, a very healthy dividend here too as well. So that kind of plays into the story as well.
RJ, the other story we're watching really closely is around wages. When you think about what's going to play out in California, April 1st, a significant bump in minimum wages for fast food workers. For a company like McDonald's, obviously it is a question around what happens to the franchisees, how big of a hit they're likely to take. How are you assessing that right now?
Yeah, it's interesting because right now we've been looking at the data for both California compared to the national average, and they haven't seen much of the impact in terms of visitation. Some of that's because McDonald's doing some very innovative stuff. Some of that is because of just noise like weather that we saw in January as well. But it's something that we've been anticipating, and we're going to watch closely as we start to see this. It could be a very big deal. And, operators in that region have talked about pulling back on labor, pulling back the number of hours, potentially adopting more automation features. McDonald's not so much, but other players have talked talked about these measures to kind of offset the wage increases in California. So it'll be interesting to see. I think there's a lot of things that QSR players are exploring, potentially adopting because of the changes in labor and wages.
And RJ, one last question, McDonald's. Another issue to consider is geopolitical risk and particularly challenges in the Middle East. How do you see that playing out, RJ, in sort of the near intermediate term here?
Yeah, I mean, certainly a risk to some of their international operations. We do see that when the company talks about it, and they've been very upfront about the fact that this has been something that has put a negative impact on foot traffic internationally. So something that we continue to keep an eye on. I think domestically, it's probably something that we won't see as much. And again, I think innovation probably trumps some of the geopolitical risk here, and being creative and finding ways to get more out of their restaurant assets with a Krispy Kreme and other things that they're doing right now.
RJ Hottovy joining us from Placer.ai. Good to talk to you today. Appreciate the time.
Thanks, Akiko.
Well, coming up, UPS getting hit hard today after unveiling its financial targets for the next 3 years. The company's CFO joins the program on the other side to discuss the outlook. Stick around, much more market domination still to come.
United Parcel Service today hosted its Investor Day conference. The company saying it was a difficult market last year, but it now sees better days ahead with the small package industry poised to return to growth. Here with more is UPS Chief Financial Officer Brian Newman. Brian, it is good to have you on the show, and I want to get right to these financial projections, Brian. So you're estimating annual consolidated revenue climbing as high as $140 $14 billion in 2026. That'd be a big jump from last year. Also calling for adjusted operating margin here above 13% in 3 years. The stock reversed early gains, Brian. It's now in the red, and perhaps some investors are kind of skeptical you'll be able to hit these financial bogeys you've laid out. What's your response to that, Brian?
Well, I think, Josh, we have great plans in front of us and a lot of confidence. The trajectory on top line growth is revenue growth of 5%, takes us to 108 billion, and then the incremental 6 billion to get to 114 that you referenced. That involves some inorganic M&A opportunities that we see. So I know there was a reversal. I think people are looking at the supply and demand capacity in the market, but net, we feel good about the top line. One thing we've proven at UPS, Josh, is we're very agile on cost, and so we see a path to the 13% margin.
And those inorganic M&A opportunities, Brian, can you give us a little more color there?
Happy to. It's not any one huge deal. The 6 billion that we're looking at from a revenue growth perspective, it would be a series of deals targeted mostly at the healthcare space, which we're very excited about, and also in the international area where we're looking to be the premium leader.
And what about pricing as well, Brian? I'm just curious how you're thinking about that dynamic as you kind of pursue these twin, revenue and margin targets. And would you be willing, Brian, to reduce share if that meant, looking ahead to protect your margins?
Josh, it's a great question. We have fairly balanced the algorithm. Right now, we're calling in the domestic business 3% volume growth over the next 3 years and 2.5% what we call RPP, revenue per piece growth, which generates that 5+% revenue. We always evaluate the trades here. Net, I want to ensure, though, better and bolder means returning to growth. So we're trying to grow in the right areas of the market, which ultimately drives the margin. When you grow SMB, you grow healthcare, and you grow international premium.
And let's talk competition too, Brian. I'm especially interested in just how you think about your relationship with Amazon. As you think about it, Brian, is that a customer? Is it a competitor? Is it a bit of both?
Yes, Josh. The answer is yes to it's both of those. We have a mutual beneficial relationship with Amazon. We are not their supply chain. We deliver a large amount of packages for them. But over the past few years, Josh, we've basically glided down the business with Amazon to a place where now we think it's the right volume in the network. So at this point, we've reached somewhat of an equilibrium, and we feel like there's a glide path forward with Amazon, finding those right packages in the market.
Brian, you reached that new labor deal, new union labor deal last year, and I'm curious, given just how much wages went up, Brian, did that deal kind of accelerate your decision to kind of bring more AI in-house, more robotics in-house?
Well, for sure. The labor deal we reached, Josh, was a 5-year deal. In aggregate, over the 5 years, it's an inflation of 3.3%. That's a very good number in aggregate. The challenge we had was the first year of the labor deal was worth about 46% of the contract. So the good news is we're going to go from, when we anniversary the first year of the contract in August, our labor inflation, wage inflation, will go down to less than 2%. What that does for us is allow us to balance the RPP, the pricing, and the cost per piece management to inflect positive margins, which then drives cash, et cetera. In terms of your question on technology, absolutely. We're trying to be more efficient and effective in everything we do. AI allows us to go faster. It also allows us to reduce the amount of reliance on labor in terms of efficiency.
You're also targeting capital spending, I see here, Brian. It looks like 24, 26, about 5.5% of total revenue. Any color of what and where you're spending on, Brian?
Yeah, Josh, the CapEx over the next 3 years will be about 5.5% of our revenue, so $17 to $18 billion. Very consistent with what we've been spending the last couple of years. The focus of that, the single biggest project, is something called Network of the Future, and it's an opportunity to drive efficiency and take cost out of the network in the U.S.
And Brian, finally here, I do want to ask you about the collapse of Baltimore's Francis Scott Key Bridge, of course, hit by that large cargo ship. There are potential economic implications, Brian. Is there going to be any impact on UPS operations?
First of all, a lot of empathy for the situation that people are going through. Terrible situation as far as our business. In your question, none of our employees were impacted. And from a workaround perspective, from a supply chain, we're always working on contingency plans to ensure packages get there on time. So not a big impact from a UPS standpoint, but certainly hearts and thoughts go out to the people affected.
Brian, thank you so much for joining the show today. Appreciate your time.
Great, Josh. Good to see you. Thank you.
It is time now for the day's trending tickers. With about 30 minutes left in the trading day, we're taking a look at the meme trade as GameStop gears up for its latest quarterly results. Reddit continues to soar post-IPO, and Trump's social media company surging after its DJT ticker debut. Yahoo Finance's Josh Schaefer and Ali Canal around the table with us here to discuss. Let's start with the definition of a meme stock. I feel like we haven't defined that lately. Has it changed? Is it about the lack of fundamentals?
It's still the lack of fundamentals, Akiko. I would say that's probably the leading thing that would define a meme stock to us and some of the strategists that I spoke with today. Steve Sosnick over at Interactive Brokers laid out 3 key points, one of them definitely being a disregard for fundamentals. We can remember how crazy GameStop got back in 2021. That was not because they were beating on earnings. That was because people wanted to buy the stock, right? And another part of that would also be, again, back to that meme rally, high short interest, right? A big part of what happens with these meme stocks is these meme traders go into companies that are highly shorted, essentially trying to start a short squeeze and be able to benefit from that. And the other key point, which I think Ali can probably hit on for us a little bit here too, would be just a passionate following, a passionate fan base, however we want to sort of phrase that. I think you could argue that Reddit, which just went public, certainly has that. GameStop had that then. And it seems like this Trump SPAC might have a little bit of that going on with it too, Ali.
Yeah, and I think if we go by your definition, the lack of fundamentals, I mean, this fits the bill, right? Yeah. Trump media does not really have any fundamentals. We were just talking about this in the break. And if you take a look at the latest SEC filing, they lost $49 million in the first 9 months of the year and brought in $3.4 million in revenue. Now, that is million with an M, not a B, which I think is very important to distinguish because based on current trading levels, you're looking at a valuation that's just about $9 billion. So this is a company that's losing money, and yet we're seeing these great returns. Now, because of the fundamentals or lack thereof, we've seen that heightened short interest in what was Digital World Acquisition Corp. That, of course, is a special purpose vehicle that merged with this company for this Nasdaq debut. And like Josh was saying, this is a very meme-like phenomenon, essentially betting that the stock price is going to come down over time and not rise. According to S3 Partners, which tracks a lot of these moves, DWAC was the most shorted SPAC in the U.S. with about 11% of outstanding shares. And public companies typically see between 3 to 4%. So this is pretty high, although you have a stock like GameStop, which has about 23% heavily shorted. So GameStop probably the highlight here, but certainly this is operating like a meme stock at the current moment.
And then the other thing, Ali, too, with that is it just seems like Reddit maybe reminded investors about the meme stock rally at some point. That was something that Steve pointed to me.
Right.
Yeah. And so for Reddit to go public and the stock to take off over the last couple of days, you wonder if it brings back some of that crowd. You would think that crowd was interested in the IPO, right? And then you see the stock move, and maybe you want to get in on other names, maybe?
Well, and this was a question we were talking about off camera, right? Does this point to the specific companies we're talking about as meme trades, or is it just about the environment, right? The sentiment that's in the market, just sort of the risk on, this is another trade. It
feels like we're getting back to the point where you can go to a bar and your friend's talking about Bitcoin being up 50%, right? I bought MicroStrategy at the start of the year. Someone might say, and it's up 200%. Like the moves in these specific names are big enough that they're becoming a little bit of a point of conversation again. Yeah. When you think about crypto, you think about those big moves. You think about a big move in Reddit, a big move in DJT. I keep wanting to say DWAC. Yeah. But those big moves kind of spark a broader conversation, I think, among the retail investor community and maybe bring out more memification.
Yeah.
All right.
We're going to hear conversations about Dogecoin next.
Yeah.
Remember that?
Shiba Inu was up today about 5%.
Let's go to a bar
for those that track
later and see if anybody talks to us about Reddit.
We'll start the conversation and see if anybody joins in.
All right, thank you guys both. Appreciate it. Take a look now at cocoa prices hitting a record as the commodity breaks above the $10,000 mark for the first time. Move higher in prices comes as cocoa faces supply constraint. Let's chat cocoa, Akiko, for a second. So this has just been a red hot rally. What is going on here? Apparently, we got poor crops in West African growers. And so per Bloomberg, we could be looking at a third straight annual supply deficit.
Higher chocolate prices, right?
That's right.
That's going to get a lot of people's attention.
For sure. And I guess it sounds like from what I'm reading, other growers like Brazil and Ecuador, you're kind of trying to hopefully ramping up production, but obviously that's not just a switch you can flip, right?
Yeah, that's going to be a big concern, especially with some of these brands. And here with more on how this is affecting confection makers, let's bring in Yahoo Finance's Brooke DePalma. Brooke, I know you've been talking to some of these companies. What are you hearing about how this is going to affect prices?
Yeah, good afternoon, Kiko. Well, confection makers like Hershey's and Mondelez are really looking to navigate the impact of higher ingredient costs, particularly cocoa. And one analyst actually downgraded shares of Hershey's, citing the recent surge of cocoa that was once expected to be transitory, well, could now be here to stay. Another expert telling Yahoo Finance it will likely be a couple of years of elevated prices due to the particular life cycle and weather conditions needed for these cocoa trees to mass produce and thrive. And both companies, though, are preparing for this lingering impact. In a call, Hershey's CEO told investors that cocoa is expected to limit earnings growth this year and plans to use every tool in its toolbox, like pricing, believe it or not, to manage this headwind, while Mondelez shared a similar anecdote and reportedly could change the size of its packaging. And of course, we've been hearing so much about that, what many call shrinkflation. And now with Easter, the third biggest candy occasion in the U.S., right around the corner, U.S. retailers like Kroger and Target plan to offer even bigger discounts compared to last year and more frequent promotions on some of the most popular treats this time of year. And according to recent insight from DataWeave, consumers can expect discounts on these iconic brands this time of year, like Cadbury, like Reese's, Hershey's, as well as M&M's, among others, as U.S. retailers look to avoid this glut of inventory that could potentially happen if consumers pull back and say, hey, we're not paying that higher price when it comes to these Easter treats.
Okay, Brooke DePalma bringing us that story. Thanks so much. We're watching shares of Viking Therapeutics surging on positive new results for its experimental weight loss pill. Joining us here to discuss, we've got Anjali Kamlani. Every time we talk about weight loss, we've got to see
I know, it's Well, listen, Viking Therapeutics is one of those companies that is really booming. We've known that it is sort of a favorite among the biotechs right now for this area, for the GLP-1s and for its weight loss numbers. Now, the results that came out today, phase 1 for its pill, which is an area really hot right now that people are keeping an eye on because it could help with the slow uptake or sort of any trepidation that others have with the injectables that we've seen on the market right now. So Eli Lilly, Novo Nordisk, those are the leaders. And so what Viking reported was, in addition to checking for the safety, which is a purpose of the phase 1 trial, they also saw a little bit of a weight loss there within the first 28 days. So that's the news that we've seen out of Viking. This is in addition to really strong numbers that they saw from their phase 2 trial of the injectable after 13 weeks. And that was a couple of weeks ago. We got that news. And so this is really setting up the stage for that really hot race we've been talking about in the GLP-1 area, where, you know, Viking could either go on its own with its strong results, could become an acquisition target for some of these other players, especially big pharma. So as of right now, this is what we've got going on. We'll have to see.
Switching to another kind of hot topic, mergers in the healthcare space, and Johnson & Johnson making some news there.
Yes, that's right. Johnson & Johnson reportedly looking at Shockwave Medical, according to the Wall Street Journal. That is a company that has been kind of growing in the last few years. They've been coming out with a new area focused on really heart disease and related treatments accordingly. So whether it's directly to the heart or leg pain that could indicate heart disease problems, that's sort of what their medical device does. This is an area, heart in general is an area that Johnson & Johnson focuses on, but it's important to note that its medical device business has been kind of stagnant in the past 10 years alone. Looking at their earnings reports, you've seen sort of that 25 billion to 30 billion annual revenue. So this could really be a boost for the company. Shockwave really up in the last several years, $730 million in revenue, and looking at a market valuation of about 11 billion. So could be an interesting market opportunity. The company says it sees 14.5 billion as the market opportunity for its device. So really interesting if it goes through. It's important to note Boston Scientific was reportedly interested in it just a short time ago. So really interesting to see if Johnson & Johnson does in fact pick it up.
Yeah, the stock getting a big pop today, up nearly 12% there. Thanks so much for that, Anjali. Well, Apple has just announced it will be holding its Worldwide Developers Conference on June 10th. Wall Street will be watching very closely as the Mag 7 tech giant sets out its latest developments in devices. Most importantly, listening out for any signs of its much-promised AI strategy. Let's bring in our friend of the show, Ray Wong, an avid Apple stock watcher. Ray, I was just checking here. Apple stock down about 11.5% year to date. Hasn't been a great start to the year. What are we expecting? What could be a potential catalyst for the stock coming out of this?
I think the big question is Apple's done so much in AI. What are they going to publicly talk about and sell and show and just help developers see what they can do with AI inside the devices? It hasn't always been explicit. It's always been ambient, happening in the background. And I think people are everyone watching is trying to figure out, hey, what's going to happen iOS 18, iPad OS 18, tvOS 18, Mac OS 15, Watch OS 11. And that's really where the magic happens for Apple. It's like how the devices come to life. And I think how the devices come to life with AI is going to be a big area for a lot of investors to watch, as well as for a lot of Apple fans. I mean, there's 30 million folks that actually watched the show last year remotely, and about a couple thousand, I think like 6,000 attend in person. So.
Ray, what did you think of those reports we saw that Apple eyeing Google Gemini for future iPhones? What did you make of that?
Yeah, I think it's really important, right? There's a lot of things where they can actually have collaborations. It could be with Google, it could be with Microsoft, it could be with other folks. And I think it's important to show that Apple's part of that ecosystem across the board. And I also hope that the important piece is that Apple doesn't get distracted by this DOJ lawsuit.
Not distracted by the DOJ lawsuit, Ray. That's something that's likely to drag on for some time. But on that specific point about Gemini, I mean, what was your read on those reports that came out? Is it about Apple being a little further behind, at least internally, than what has been publicly reported? Or is this just one step that Apple already had in place to get to ultimately what they are working on internally, integrating that into their product?
I think it's one step in towards integration to the product. I believe that those Google discussions have been happening for quite some time. And I think there's other discussions with other software vendors in terms of actually leveraging their capabilities. So whether it's something in collaboration or it's something in video or something that's going to be in terms of email or something that's in other arts around the work and the enterprise environment, I think you'll see some of those partnerships emerge.
Ray, what about the headline we saw today? Apple's iPhone shipments in China, Ray, they fell about 30% in February from a year earlier. That's according to official data. What's driving that, Ray? Is that just the shaky economy over there in China? Is that competition from Huawei? How do you explain it?
Yeah, the number one issue that's happening is really the China ban that's going on. There's a big push to get rid of Apple phones or Western technologies like Intel, as you heard earlier in the day. It's really a all-out war in terms of reducing dependency on the West. And that's just part one of it. And if you also notice on the other end, Huawei's numbers are up. And they're making up for that difference. And so you're seeing a big purge that's going on in China of Western technologies. Anything we're competing against them on or anything they want to reduce dependency on us, you're seeing that push. So for example, if they're going to hit hard on Apple and iPhones, well then, we're probably going to block them on BYD and EVs coming in the other direction. And then Tesla is going to get hit. So we're in a very, very weird trade war and very, very tenuous until we get past the election.
Ray, on the Apple's, the China stuff specifically, though, one of the things we were talking about the other day when it was reported that that China would essentially stop using Intel and AMD from government computers, devices. The question is how significant that piece of the China pie is. So, in other words, if we're talking about Apple, it's as far as we know about government devices, maybe it goes into state-backed companies as well. But in your assessment, when you look at the overall revenue picture for Apple, how significant is that portion of the ban?
Yeah, that portion of the ban probably is maybe about 10% of the overall consumer population in China. So it's not a big portion of it, but it signals a message that if you're using a Western phone, and using an Apple device, you might be under scrutiny. And it's kind of a fear factor. So it's China's way of kind of like dipping their toe in and saying, hey, we're banning Apple phones, but not really banning Apple phones. Kind of like how we're banning TikTok and government devices, but not really banning it across the board. So they're just copying that ban.
Ray, thanks as always for joining us today. Appreciate it.
Hey, thanks a lot. Take care.
Stick around. More market domination coming right up. The S&P 500 on track for its 5th straight month of gains, which is a good sign for investors moving forward. Yahoo Finance's Jared Blickery joins us now for more. Jared.
Thank you. Have we come too far too fast? That's the question all investors have on their mind. And history is saying, well, it doesn't matter that much. Strength begets strength. And that's important because we're talking about stocks. We're not talking about commodities, which tend to feature mean reversion. Prices tend to trend in stocks and mainly to the upside. So that's what we're seeing here. So what happens after an S&P 500 5-month winning streak? Well, 1 month later, we do have some gains typically. Over the last 74 years, go all the way back to 1950, you have a gain of about 0.7%. That's any given month. Now, after a 5-month winning streak, that is 1%. So that's a little bit higher. Over 12 months, 1 year later, we're looking at gains on average of 12.5% with over a 90% win rate. That is significantly higher than the 9.5% chance that you have in a 1 year period over these last 74 years. And then also, and I'm writing about this in the morning brief tomorrow, going into a little bit more detail about some of the sector action that we've seen in this 5-month rally. But here we are. Here are the S&P 500 sectors. You'll notice that XLK, that's tech, is number one, almost 30%, but closely on its heels is the financial sector. That's 29%. That includes JP Morgan as well as Berkshire Hathaway, by the way. Communication services, that's a mega cap sector with Alphabet and Meta. That's right up there too, 28%. But here's industrials, another sleeper. Let me just show you a 5-year chart because we started breaking to the upside after a significant consolidation only last year. And when we think about industrials, we've had twice as many record closing highs in the industrial sector versus tech. So big point is we probably will see more strength, and it's just a question of which sectors we're going to see it in, not necessarily tech, right?
Exactly. Well, we're going to see where our guests weigh in on that. Jared, thanks so much for that. What's been a record-setting start to 2024? We are revisiting the calls made at the end of last year to see which hold up and which are in need of repositioning in the Yahoo Finance playbook. Joining us today is Thomas Hayes, Great Hill Capital Chairman and Managing Member, and Nancy Tengler, Laffer Tengler Investments CEO and CIO. Nancy, let's start with you because back in December, you recommended investors buy Broadcom for its exposure to the AI rally, calling it the poor man's Nvidia. But do you still stand by that call?
Yeah, I've been pretty pleased with it, Akiko. I mean, the stock pulled back on earnings, but then they had an investor day, and I think investors came away with a clearer picture about the future. I think on any pullbacks, you want to own this stock if you don't already own it. Strong dividend growth, the capital allocation plan that really rewards shareholders, and a management team that has been able to make major acquisitions and then rationalize them very quickly and very well. And then, of course, the AI component, which will continue to grow.
And Thomas, let's bring you in here as well. You know, you look at this market, Thomas, this kind of just steady climb higher. I'm just curious, how has your investment strategy, if at all, changed so far this year?
Well, we've been publicly bullish nonstop for a year and a half, and we've recently become more cautious. We're up 17 out of the last 21 weeks. No 2% pullback in the last 100 trading days. So in recent weeks, we put on a 2% hedge, 1% put spreads on the S&P, 1% put spreads on the semiconductor index, and 98% long. So if we're right, those have an expected value of 5x each, so we'll create 10% of new capital. If we're wrong, we think there's enough beta in the portfolio that even that cost of 2% will get eaten by outperformance to the S&P. So, but if you look at mixed messages. Margin levels are down. They're not really super elevated. So a big correction of 10%, I don't think that's in the cards. I think more like a 3 to 8% would be kind of a normal, healthy thing to see, and sector rotation happening under the surface like Jared was talking about.
Why single out semiconductors and S&P specifically?
I'm looking for what's a little bit stretched, where the multiples are stretched, where a lot of people are chasing the shiny objects. All the people that were bearish, we flipped all the bears. You know the names who have been bearish for a year and a half, and now they're all flipping. And where are they flipping to? They're getting excited about stocks that have already run up 100% plus. And we like to skate to where the puck is going, not to where it already has gone.
And Nancy, I want to bring you here as well. When you talk to your clients, Nancy, and they're asking you what are some of the risks that are really on your radar right now, what do you tell them? Is it valuation, seasonality? What are you thinking about?
Well, so Josh, we're long-term investors, and we tend to move at glacial speed. But we were adding, as you know, we've talked about this, to tech and consumer discretionary in October of 2022, and then again after trimming them in 2023, we were adding to back to some of the names in October, and then we started broadening out the portfolio. October, of last year, we started broadening out the portfolio, really to have the improvement in some of the names that we've seen in healthcare, financial, some of the more cyclical names were overweight industrials. But my biggest concern is that the Fed seems to be, I guess, walking away from their data dependence, and put quotes around that, that they've had in the past. And it seems they're determined to cut. And so we've drawn an analogy to the 90s. We think you can have higher inflation, but not materially higher. And so that's my worry, that we get a surge in inflation because the Fed is too easy. But we've drawn the analogy to the 90s, and we think that's still accurate. Higher inflation and higher interest rates can coexist with strong stock prices. And that's what we had in the 90s when I was a young portfolio manager. And I think we're going to see that again due to productivity. So I'm not running away from tech. We're just broadening out, because I think you want to own the old economy companies that are embracing the digital revolution, generative AI, cloud computing, and then the suppliers of those picks and shovels in that space.
Thomas, I see you nodding your head as Nancy sort of makes her case here. I mean, you recommended investors buy Baxter, but skip Eli Lilly the last time we were on. How has that assessment changed, or has it changed beyond that?
Still the same. They call me Turnaround Tom. I like buying out of favor, high quality businesses. Baxter is one of those. It got smashed because of over inventorying, absorbing the Hillrom acquisition, and then of course the crescendo was in the fall, GLP-1s. No one was ever going to need a medical procedure again, and all that basket flushed out in October. So we took advantage of that. It's up 15%, give or take, since, a little bit higher. The big story is they're trading at 12.5 times forward. They historically traded at an 18 times PE. Why are they trading at a lower PE? Is because their kidney business is the slowest growing part of their business, of the four parts. They had planned to spin that to shareholders by the summer, which means the RemainCo could re-rate to a much higher multiple, which we think is a great opportunity. But in the last few weeks, there have been rumors that private equity may be bidding for that kidney business. So it may happen much faster, enabling them to de-lever. And the $1 billion of free cash flow they generated last year, that's going to continue to grow. We'll get the re-rating from the three faster growing businesses. And we think this can continue to climb higher, work its way towards 60 and beyond over the next 12 to 24 months.
What about, Thomas, what about Boeing, by the way? Any thoughts there? I mean, we just had obviously big news, changes in the C-suite.
I love it. Love it.
Why do you love it, Thomas?
Well, we bought this in the last week and a half. So we bought some in 179, mid 180s. Our basis is 183. This is the least amount of research and diligence that we've ever done on a purchase, because effectively they delivered 528 planes last year. They've got a 5,600 backlog. So if you're Southwest and you say, Boeing, you're a complete disaster, I can't believe how many mistakes you're making, I'm going to Airbus. Good for you. You're going to get your next new plane 20 years from now. So Boeing has a moat. They operate in a duopoly. They're going to get a new CEO, which is fantastic. They need an engineer, not a salesman. They've got enough sales. They need someone to manage the shop and make sure there are no issues moving forward.
Insider or outsider? You have a preference for the next CEO?
Probably an outsider. A fresh set of eyes would be nice. I definitely agree with that.
All right. Thomas, Nancy, thank you both for joining the show today. Appreciate it.
Thank you.
Well, we're wrapping up today's market domination. Don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for market domination overtime. That's the closing bell on Wall Street, and now it's market domination overtime. Akiko and I are joined by Jared Blickery to get you up to speed on the action for today's trade. Let's see where the major averages ended. So we were modestly higher. Now we're kind of ticking down. Call it modestly lower here. You can see the Dow is basically finishing relatively flat here. The tech-heavy Nasdaq is down about 0.4%. Meanwhile, the S&P 500 is down about, call it 0.3%. Of course, we're coming off a very strong week, modestly lower here. We also know traders are aware they have a big economic data point coming on Friday. That's the Fed's preferred inflation gauge. Remember, markets will be closed here. Regardless, listen, maybe some modest losses today. The S&P 500, still, what a run, on track for 5 consecutive months of gains. Jared, over to you for a closer look at today's sector action.
Thank you, Josh. You can't win them all, but we could win a few sectors here. You can see behind me healthcare managing to finish in the green. It's leading the way, followed by financials, consumer discretionaries, and staples. Remember, I just said over the last 5 months, financials is actually one of the top performing sectors along with tech. But today we're seeing utilities. That is the worst performer. That's down over 1%, followed by energy, real estate. Then you get into tech and industrials. Bottom row, all underperforming, I should say. And also taking a look at some of our leaders. It was really a day about cannabis. We've seen a very volatile price action, and that happened to be lagging yesterday, leading to the downside. Today it's leading to the upside, but for the most part, not seeing a whole lot of winners here. In fact, the biggest loser I have on my leaderboard is Bitcoin. That is down another 2%, Josh.
Jared Blickery, thank you, my friend. One of today's top stories that investors have more risk appetite to add to the market rally, and Josh Schaefer and Miles Udland are here with the takeaways. Miles, give me a takeaway.
Sure. I mean, I think we lost a little bit of our story in the last 15 minutes of trading. But, as Josh wrote today on the site, I think this is the meme trade coming back. And it's really got two factors to it. The first we could have guessed, and we talked about it before Reddit came public, that Reddit, the source, let's call it the home base of the meme trade 1.0, of course the stock had to be part of some kind of meme action. You see what's happening in those shares, and it certainly adds up. But then with Trump's SPAC coming public today, another story that I don't really think surprises anybody is getting memeified to an extent. You saw the action ahead of the approval last Friday, and then, of course, the action today with the conversion to, what a great ticker. I mean, the ticker is just perfect, says it all. And to see that stock, up 50, 60% in its highs today, it shows that there's appetite for this still in the market. And, Josh Schaefer, I know you have talked to some folks who are still trying to argue effectively that it's fine, it's about fundamentals, but you look at the board today, look at the tape, and it doesn't feel super fundamental on a day like today.
Is 40% in Krispy Kreme stock in one day because they extended a partnership with McDonald's a pure fundamental story? No, right?
Doesn't the market incorporate all available information for Discount Back to the Future?
So you can get there, right? Yeah. Sure, we could help explain it that way. But I think that move specifically to me, I mean, I even look at Tesla up 3% today. At one point it was up 5%. It seems like people are just looking for an excuse to buy sometimes in terms of news. Again, Tesla coming out with a 1 month free self-driving thing. Is that really?
Which was at the heart of the recall. I mean, I keep bringing it up.
Right.
This is not the most...
It's been a bad fundamental story for Tesla, right? That's why the stock's been crushed. But you're seeing people looking for maybe some reason to buy in some area of the market like Tesla where it's just kind of been beaten down. So that was one thing that stuck out to me. But to get back to sort of what Miles was highlighting, one of the folks I talked to today was a team over at Deutsche Bank, and they were highlighting just overall risk appetite that we're seeing in the market right now. And they're looking at fund flows. So when you look at the flows, they include cyclical trends in there and seasonal trends in there. And when you include that, so you basically account for the fundamental backing, they don't see nearly the risk-taking that we saw in, say, 2021. In 2021, their chart completely spikes, and that's because that trade got very disengaged from fundamentals. And right now, a lot of teams are arguing that we're not quite there yet. Here you go, there's the chart. You can see 2021, we had a massive uptick over our little red dotted extreme line. That's the meme stock rally. And you look at where we are right now, we're just simply pretty far away from that. I was saying to Miles, this is one of the only times we talked about meme stocks during this
Well, so the only thing I would add, though, to that outline is that if you look at that chart and you think about the outline from 2020 into 21, the meme stock rally really led like that full blow off top by a good 6 months. It was really the summer, like Q3 of 21 is when we put in a lot of those highs. There was actually kind of, I wouldn't say a washout, there was a huge pullback in a lot of these smaller names that had gone public late 2020 in the spring of 21. And then the summer thing, everything kind of came back. That was the idea, maybe it's transitory on inflation, maybe the Fed won't have to be as aggressive as we think. And that blow off top, as much as there was one, was really like September, October, November is when you had the highs in Bitcoin.
I was going to say that. Well, if you think about the last record that was set, it's November 2021, right? So is that where we're headed?
Well, I guess the argument here would be like this, if you want to make that case, and we're just journalists, what do we know? But I think if people on the street out there, investors want to start making that case that that's what we're seeing here, I think meme stocks have always been a leading indicator of where sentiment could be headed. Now, you could say maybe it's been in reverse. I mean, Nvidia is a $2-3 trillion company almost, and they've been the leader. Like, that's not really a meme stock. Like, they have a real business and they're riding the whole wave, all that kind of stuff. But if you look at the action in Reddit, Krispy Kreme going up 30% on McDonald's partnership, all this kind of stuff out there in the market, you could say, from the hindsight of, call it October 2024, oh, okay, yeah, that's what was going on there. Now we know why we are where we are.
And ultimately, what's fueling the sentiment? Is it the Fed? Is it this expectation of the start of a rate cutting cycle?
Yeah, and it's the economic growth story that we're hearing from the Fed and just the overall economic data that we're seeing, right? I talked to multiple strategists today essentially asking, what are the risks here? What brings us lower? It feels like everyone's saying risks are to the upside. Why is that? And they're saying it's because the economic growth story is still intact. So it would be either hot inflation prints, right, that get us concerned about the Fed rate cutting cycle. It would be actual continued slowdown maybe in some of the consumer spending details that we've been looking at. You saw like a little blip in retail sales, but there just hasn't been consistency. And it seems like people just want to see a consistent sign, essentially a reason to sell, because we sort of look past every reason to sell we've talked about over the last couple of months.
Or something's coming, you just don't even know what.
Right, yeah, no,
Well,
that's always
that was my
important.
next question, is like, what is the one thing that could potentially derail this? Obviously.
Well, I think don't we all know the answer though, right? It's all the election. That's what everyone's going to say. Everyone's going to roll through here the next 6 months and we ask that question. I think that's the thing you would have to say, because it's what it would be. But I think ultimately when you look at like the setup for markets right here, and something John Stolfitz said yesterday really stood out to me. He's like, well, all the bears are kind of going home. And I mean, don't we all know that's the story? Like at the end of the day, it's when no one wants to be bearish. It's very lonely to be bearish, I think, to your question, Akiko. That's when I think you can start to feel like, that's interesting.
Where'd
those guys go? Yeah, I feel like every time, I don't know if it's Josh Lipton's thing. Every time I come on here, I end up being like bearish or skeptical, which I'm not.
You're blaming that on me,
Miles? You guys bring it out of me. You bring it out of me.
It's healthy. I bring out a healthy skepticism.
Julie Hyman's not even here, and I'm going to blame her.
Right?
I have no opinions. I'm very
Healthy
neutral.
skepticism is a good thing.
Now, Miles is fair, neutral, right down the middle. That's what a financial
Stocks
journalist
usually
says.
go up, though. That's it. I'm here to report that.
That's all I wanted to hear.
Exactly.
Josh, Miles, thank you so much. Appreciate it, guys. Well, Miles was just talking about this. So with the presidential election approaching, many investors might be wondering how politics will affect their portfolios. Our next guest is doing extensive research on how stocks do during an election year. Joining us now is Wes Krill, Vice President and Senior Investment Director at Dimensional Fund Advisors. Wes, it is good to see you. So I imagine, Wes, this is a topic of conversation with your clients. They must be asking you all kinds of questions. What is this election going to mean for their portfolios? What are you telling them, Wes?
Yeah, and thanks for having me on today. I think it's a very natural question for investors to have. They might have certain expectations for how the presidential race is going to play out and the ramifications for the stock market from there. But one thing we always encourage investors to remember is that when we look back at the history of the stock market, when you break it up into different presidential terms, it's been remarkable in its consistent ascent through the years. There's been 16 different presidents since 1929. 13 of them have left the White House with the stock market higher than when they became president. And I think this goes back to first principles. If you think about, as a business owner, what are my objectives at the end of the day? Well, I'm trying to maximize my revenues, trying to minimize my costs so that I can grow my profits. I'm going to have that objective as a business owner, no matter who is in the White House, whether it's a Republican or a Democrat. So I think that's consistent with what we see, that over the long haul, stocks have rewarded investors who stayed disciplined with their asset allocation.
With that said, Wes, I have to wonder if history is a gauge for this type of election when you're talking about two candidates who have both been in the White House, one currently in the White House, one formerly in the White House, two very unpopular candidates as well. I mean, is this a gauge? Can we use history as a measure of what the market reaction is likely to be given the historic nature of this particular presidential election?
Yeah, we don't have to go too far back in history to see evidence of the fact that there's many things that will impact markets above and beyond the presidential election. We can go back to 2020. So many of you will recall the election results were finalized over the course of the weekend. Well, Monday morning, November 9th, 2020, for those historians out there, looked at markets, and we saw that value stocks in the U.S. were outperforming growth stocks by 9 percentage points that day. Now, just to put some context around that, that's the third best outcome for value versus growth in almost 26,000 days of recorded history in the U.S. stock market. Was it because of the election? No, it was because that same day Pfizer had released the efficacy results for their vaccine testing. We saw that there was the potential for the pandemic to end more quickly than many of us had expected at the time. So that could have been a big needle mover. And so I think that's a reminder that whatever plays out with this election, even if your favorite candidate doesn't end up making it into the White House, there's so many other things that are going to drive the performance of the stock market. And unless you can predict what those other pieces of news are going to be, it's best to stay invested and capture what the market has to deliver.
I'm interested too, Wes, while we have you, just switching gears, just your general take on the market. Obviously continues to grind, has been grinding higher here. Does it continue in the near to intermediate term, do you think, Wes?
Yeah, one of the things that gives investors pause when they're seeing a market going up is they think, well, you know, when it hits a new high, does that mean that there's going to be downside risk? And some people think of it as a new high as a cliff. That's not what we see in the data. In fact, when you look at every time the U.S. market has hit a new high, the subsequent 3-year return looks like just an unconditional return over any randomly selected 3 years. And it's consistent with the idea that people are not going to invest in stocks unless they are getting a positive expected return. Right? You know, stocks bring with them a certain level of risk. And if you're not getting compensation for that risk, investors aren't going to sign up for that. So the market has to have a positive expected return. We know there can be adverse developments, new information comes to light that can drive markets downward. But where we sit today, based on the information market participants have, whatever their expectations are for the future, that is being built into current market prices so that there's an expected return that's positive for stocks.
Finally, Wes, if we can bring it back to maybe political policy here. You know, when you think about the former president, Donald Trump has talked about, you know, if he wins this election, he would like to extend the tax cuts that were put in place under his administration. He's also talked about ramping up tariffs as well. As an investor, how do you look at that right now? How do you assess that beyond the November election?
Yeah, I think any of these sort of policy changes are things where the intent behind it, the potential ramifications, the way it's going to unfold, these are largely going to be known in advance. It might not be 100% certainty that they're going to go through, but whatever the process is going to be, investors have ample time to bake in their expectations for these outcomes. It's not unlike economic expectations or, you know, things that are relatively slow moving that are signaled far in advance. Fed activity is another classic one. And what we see is that investors generally have not been able to successfully get ahead of those types of outcomes. And again, if we think about what could impact market prices from a presidential campaign or regulatory reform point of view, there's going to be so many other things simultaneously that are going to impact market prices that, if anything, it's just going to be part of the great den of uncertainty and not something investors can really get ahead of when it comes to their portfolios. We often say investors should vote with their ballots, not with their portfolios.
Okay, some good takeaways there. Wes Krill, it's good to talk to you today. Really appreciate the time.
Thank you.
Well, Apple is facing big antitrust lawsuits both here in the U.S. and across the pond, with the Department of Justice here claiming that it is monopolizing the smartphone market, particularly when it comes to its App Store controls. 16 attorney generals joining the Justice Department in bringing the case forward, including our next guest, New Jersey Attorney General Matt Platkin. Good to talk to you today. Let me just have you walk you through your case here. I'm looking at the statement you put out saying specifically that Apple is in violation of the Sherman Act with its exclusionary and anti-competitive practices. What specifically is anti-competitive of the way Apple operates?
Sure. Well, thank you for having me. I think as we lay out in the complaint, and I'm honored to join the Department of Justice and, as you said, 15 other states in filing this complaint last week. What we lay out is a pattern that Apple has engaged in of using its market share to restrict and exclude business practices in a way that stifles innovation and makes it harder for consumers to leave the iPhone platform. And as a result of that, it has driven up significantly its own profits and the cost of the products to consumers, so that now in 2024, people are paying over $1,500 for an iPhone, that if you adjust the 2007 price of an iPhone for inflation, it would only be $450.
So I guess, Matt, I'm trying to understand. So consumers are paying this much for an iPhone, but Matt, I'm still trying to understand what the consumer harm is. If you look at customer satisfaction rates for iPhones, Matt, and this isn't my opinion. I mean, we have the data. They're off the charts, right? I mean, people love the iPhone. They buy it. Every September, Tim Cook introduces a new one. They buy that too. And if they didn't want to buy it, they have alternatives, right? There are Android devices.
Well, actually, as we allege in the complaint, Apple's practices have made it harder for people to switch off their platform. So they don't allow things like super apps on their platform, which would allow you to do multiple things in a cloud-based app, messages, purchase products, play games, the way you can on other platforms. On those apps, when they're cloud-based, you don't need the expensive hardware that an iPhone requires. That would allow you to switch to a lower cost platform. Apple has made it harder to do that. They don't allow tap to pay on their any wallet other than their own wallet. They don't allow third-party app stores on their platform, even though they're beginning to allow that in other markets. So there's a number of things that Apple has done that, yes, are people still purchasing iPhones? They are. 7 in 10 almost of every smartphone is an iPhone. But the reason, a significant reason why people are staying on the iPhone platform is because Apple has deliberately made it harder for people to leave their platform by engaging in these exclusionary business practices.
Well, that'll be your argument, Matt, but won't Apple say, listen, people stick with our iPhone and because they're satisfied, because they're loyal, because they're happy with the product?
Apple is free to make whatever arguments they want, but the facts are clear. When you see the practices that Apple has engaged in that other developers cannot do simply because they're not as big as Apple. It harkens back to the practices we saw Microsoft engage in the 1990s, when Apple was a lead witness in the Department of Justice and States Attorneys General case against Microsoft. That case is ultimately what allowed the iTunes platform to go on the Microsoft Windows platform, which led to the iPod and the iPhone. So Apple's very familiar with the playbook that Microsoft engaged in. Ultimately, Apple has largely adopted that playbook, in our opinion.
Matt, what's the resolution here? What are you looking for on the other end of this?
Look, the remedies here will play out through the courts, but I think, as I said, you can look at a number of the specific practices that we lay out in the complaint and see things like the fact that they're not allowing tap to pay on third-party wallets. Again, a way that consumers now overwhelmingly choose to pay for their products using the tap to pay function. They're not allowing third-party app stores. They're not allowing super apps, cloud-based apps, which could be more easily transferred to other phone platforms other than the iPhone. So there's a number of steps that Apple could take that has chosen not to, including, by the way, deliberately changing the experience of the dreaded, green bubble that we all see on whenever you're texting from an iPhone to an app to an Android.
At the end of the day, don't consumers still have a choice? We're not just talking one other device. I mean, to Josh's point, there are plenty of Android devices out there. Consumers have the option to leave, correct?
Consumers have an option, but they've made it deliberately. They've used their market control to make it harder for consumers to exercise that choice. They've deliberately made it difficult and to transfer your information. If you can only use tap to pay on the Apple Wallet, then you're going to use the Apple Wallet, which can only be used on an iPhone. And the more information you gather through that wallet, it makes it harder to transition to a new platform. Again, very similar to what we saw Microsoft do in the 90s that ultimately led to the development of Apple as a leading technology company.
Matt, when you target an iconic company like Apple, are you concerned at all about the potential impact you could have on the kind of innovation and dynamism that really does make the American tech community in many ways the envy of the world?
You know, we hear that in virtually every large antitrust case that's ever been brought by the Department of Justice and by states' attorneys general. And I would argue, and we argue in the complaint, that these practices stifle innovation. And again, I keep going back to it. Look at Apple's own experience. If the Microsoft platform did never allow iTunes, you would not have an iPhone or an iPod right now. Those restrictive and exclusionary business practices that Microsoft engaged in that required a large suit, you heard the same things, that we're going to disrupt innovation. Everybody wants innovation. And nobody is saying you can't have a large company. It's when you use the size of your company and the market share to exclude business practices strictly to keep customers from switching your platform, that's when you violate the law.
You know, final question on timeline, Matt. You know, Apple's been, makes it very clear they're going to fight this, and they certainly have the money to do so. They have the money to go toe-to-toe with the U.S. government. How long could this actually drag on for, Matt? Could we be talking years here?
Well, as Attorney General Garland said last week, we wouldn't file a lawsuit against a company like Apple or against any company if we weren't prepared to for the fight and to win it. And that's what we're prepared to do. And so as long as it takes, we will be there ready for the fight.
All right. Look forward to speaking to you again as the fight continues. Matt, thanks for joining us.
Thank you.
Coming up, as iPhone shipments to China have fallen by a third compared to last year, we're asking the question, has China lost its appetite for Apple? More on that when market domination over time returns.
Well, China's lost its taste for Apple. That's at least according to new data analyzed by Bloomberg that shows iPhone shipments to China have fallen by a third compared to last year. Now, Apple's been facing a number of issues in the country as it sees continued in low demand for its flagship device in its most important overseas market. That's not the only headwind it's facing. Dan Halley is here with more. And Dan, of course, we've got the bans in place for some of the government agencies. How much of that is leading to the declines we're seeing in iPhone shipments there?
Yeah, it's hard to tell exactly, right? Those are limited to government agencies, and there's far more consumers that would be able to buy iPhones than just government employees. But that 33% year-over-year decline, that's according to Bloomberg citing Chinese government data, is really stark. We had Counterpoint Research in the earlier part of this month saying that sales fell 24% in China for the first 6 weeks of 2024. Overall smartphone shipments, though, it's worth pointing out, declined in China 7% during the same period. So it's not just that Apple was declining, it's that other smartphone makers were declining. And then it's also important to point out that there was a large jump in sales around the same time last year because of pent-up demand during the end of 2022. And so, it's a number of factors, but it's not looking very good as far as Apple goes, especially with the softer economy in China. We did see Huawei tick up pretty high, but again, that's because they were basically on death's door because of the U.S. chip bans until they managed to get their own chips in place and start selling again. But it behooves Apple to kind of get this under control. Obviously, they're aware of that. Tim Cook was there earlier this week going to the opening of the new flagship store in Shanghai and then meeting with the Chinese President Xi Jinping to kind of join other tech leaders in ensuring their kind of positioning in the country. So, but overall, I mean, you look at a number like this of 33%, and then you look at the antitrust battle that you guys were just talking about. You look at the new potential investigation that the EU is launching as far as the Digital Markets Act against Apple, as well as other major tech players. You match that up with the earlier part of this year where we saw issues with the Apple Watch and the company having to take the blood oxygen sensor out of that. And it really is just, this compounding number of problems that the company seems to be facing at this point. They just announced their WWDC event for June 10th. We're expected to see at least some kind of generative AI announcement. That's something that they've been woefully behind in, and that could prove to be a catalyst for them. But for a company that was riding high for so long, it's not doing poorly, by the way. It's still one of the richest companies in the world, but it's fallen behind Microsoft, and its stock has not been doing well so far this year. It's down more than 7% year to date, and up just 6.25% over the last 12 months. You look at Microsoft, you look at Google, they're doing a heck of a lot better.
Dan Halley, thank you, sir. Appreciate it. Time now for To Watch Wednesday, March 27th. We're going to start off on the earnings front. Carnival, Walgreens, and RH are among the key names reporting tomorrow. Carnival announcing first quarter earnings for 2024 ahead of the opening bell. The American Cruise Line having a slow start to the year. It's down about 8% year to date and closing lower today.
Moving on to the Fed, we're getting some more Fed commentary tomorrow. Fed Governor Christopher Waller scheduled to speak in the evening. This comes after Chicago Fed President Austin Goolsbee told Yahoo Finance on Monday that 3 rate cuts in 2024 are, quote, in line with his thinking. Waller's comments also coming ahead of Friday's PCE reading, the Fed's preferred inflation gauge. And Robinhood is hosting a live stream event tonight where CEO Vlad Tenev will unveil details of new business plans and expectations for the company. Tune in to Yahoo Finance tomorrow morning at 9:40 a.m. Eastern for our in-studio interview with Robinhood CEO, founder, and CEO Vlad Tenev. That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow for all of your coverage leading up to and after the closing bell. Stay tuned for more Yahoo Finance on the other side.
Startup Wonder is looking to take its food delivery business to the next level, with sights set on an initial public offering in the coming years and adding several new locations. Wonder is putting its fresh $700 million capital raise to good work. Joining us here to discuss is founder and CEO of Wonder Group, Mark Lowry. Mark, good to get some time with you. It's been been a while. Lots popping over there at Wonder.
Yeah, great to see you at the HDR location Upper West Side, right?
$700 million. Yeah, that's a lot of money, man. What are you going to use it for?
Yeah, it's really expansion now. We've proven the business model, and we've got 11 units open right now. We're opening 25 more units this year and another 55 next year, all in the New York metro area. So a lot of it is just continued expansion, continued investment in R&D. We're sort of continuing to look at sort of what the next generation kitchen looks like with automation. And right now we're able to cook 30 restaurants in a 2,800 square foot kitchen with 3 pieces of electric cooking equipment. So there's no hood, there's no flames, there's no stove.
That's crazy.
But there's other things that we can do to take it to the next level as well.
What does an automated Wonder look like? Because it was about a year ago. I saw what you did, and it was pretty mind-blowing. I mean, what does an automated location look like, and how are you going to build that out?
Yeah, I mean, you have the ability to order from multiple restaurants, all with separate branding, in one checkout, one delivery. We set a maximum 6-minute delivery radius in the city. So the food's getting cooked in, on average now, 6.5 minutes, and the delivery time is 6 minutes. We do keep a queue during peak, so it's about a 30-minute order to eat. But off-peak hours, you can get it in 15 minutes, 3-4 different restaurants, all cooked to perfection and delivered hot to your door.
Did I see that right, that this is now going into a couple Walmarts?
It's in a Walmart, and it's going into a couple more. Yeah,
you must know a couple people at Walmart. Of course, Mark led Walmart U.S. e-commerce, but it pays to know people.
Yeah. we basically opened up in Quakertown, Pennsylvania, in a Walmart about a month ago, and it's doing great. We've got 8 restaurants live in what used to be a Subway there, in about 750 square feet. We're adding 2 more restaurants in there very soon. Marcus Samuelsson, Street Bird, is going into their fried chicken sandwich concept, and one other one. So we're
Thank you for replacing Subway and Walmart. I know you're not going to say, look, Subway's, it's got to go. I mean, but is that part of your passion here to democratize good food? I think back when I was going to Walmart as a kid, I went into like McDonald's. I went to those Subways. I didn't have anything like this before.
Yeah, I mean, our mission is to make great food more accessible. And so with the Wonder model, we're able to bring fractional restaurants into a small space, so we can bring restaurants to places that would never make sense to, exist on a standalone basis. So yeah, we are giving people access to food they never otherwise would have been able to get.
Why are you so passionate about this? You've created so many businesses. Why food delivery?
Yeah, customer behavior is changing. We're at the sort of beginning stages, I think, of a mega trend, and people are not cooking as much. They're putting much more value in their time, putting a premium on convenience. And I just see like food delivery exploding in the US and around the world, and I think that trend's going to continue. And just think there was a big opportunity to vertically integrate, to basically own the cooking, the delivery, the physical brick and mortar, the technology, and integrate everything together to offer customers a much elevated sort of customer experience when it comes to dining in your own living room or in your own dining room.
How hard was it to raise this amount of money in this market?
It was definitely a tough market. I've been raising money now since the late 90s, so 25 years, I guess, a professional fundraiser at this point, you could say. But, back in 2000, 2008, I think it was like 2015, just recently, every, 8 years or so, 7, 8 years, you kind of see, a really tough market to raise. And it's the same cycle over and over again. There's sort of a bubble and euphoria, and people are making money and making lots of bad investments, and then the market sort of corrects, flushes that out, and then great companies get funded, and then they make the new market, and then the money starts to flow in. It goes back up again. The bubble builds, and then it ultimately busts again. And so we're in a cycle now. We're in sort of that trough. I think we're starting to come out of it. I think the last 18 months have been really tough. I think we're starting to come out of it now, but I think we still got a little ways to go before the market starts, on the private side at least, starts to really roll.
You're a real business, Mark, and Wonder, doing real things, trying to sell real food and make things more accessible. Is it just a lot of money is going after bad AI software companies? You've been around tech enough. I mean, what do these valuations look like out there?
Yeah, actually, I'm not that familiar with the valuations in AI right now because I'm just so focused on Wonder. But I do know and hearing just a lot of companies getting funded in the space. I tried adding AI after
Wonder.ai.
Wonder.ai. It didn't work, but I think we're going to see that similar type of bubble where there'll be some big winners, but there'll be a lot of losers in the space. And I think the business we're building at Wonder is meant to sustain through any market. It is food. Everyone eats. And our big vision is to create the super app for mealtime. So anytime you want to eat breakfast, lunch, and dinner, you pull up the Wonder app and you can get a meal. Either it could be delivered first party by our experience. It could be a meal kit, Blue Apron, the company that we bought. It could be an oven-ready meal. Basically, all the ways in which somebody would want to consume food, we want to be there for the customer.
I've covered your career for a long time, and I really only known you, Mark, to have a lot of successes. Diapers.com, Jets.com, what you did with Walmart e-commerce. Do you ever wonder that, or just concerned that Wonder doesn't work? Does your mind even work like that? Are you worried that, I don't know, maybe this just doesn't work out? I don't know. I have no idea.
No, I don't waste any time thinking about what went wrong in the past, and don't spend any time worrying about the future. It's always in the now. We know what the vision is, and we know what we got to do today. And the goal is to get as much done today to move us toward our ultimate vision. And there's really no time to think about what ifs. Something doesn't work. It's going to work.
Lastly, before I let you go, last time we talked about Tolosa, your city. Where does that stand? I mean, I still visit the site from time to time. It like looks mind-blowing and futuristic, but what's any update on there?
There's no update. There's a team working on it. I'm not involved. I can't do more than one thing at once. When I'm all in on a startup, I just made a big personal investment in this round as well. Yeah.
Wow.
Yeah, and made a big personal investment. I'm all in. I'm working 100 hours a week, morning till night on this. And it's the only way I know how to do it. Like if you want to create something that's long-standing, you just have to put all your time into it. And so there's really no time for Tolosa, although I still think it's a great idea. And maybe 10 years from now I'll get back to it. But yeah.
Well, maybe I'll be living there by then. Mark Lurie, always nice to see you. Good luck with Wonder, and appreciate what you guys are building over there.
Thank you, Brian.
All right, much more coming up on Yahoo Finance Live.
We are watching shares of GameStop plummeting after the company's sales and adjusted earnings per share during the fourth quarter missed the street's expectations. You see the stock down nearly 15% right now. Josh, running us through the numbers here in the fiscal fourth quarter, GameStop reported adjusted earnings of 22 cents a share. The street was expecting much more than that. 30 cents a share is what we're looking at. The company's revenue coming in at $1.79 billion. That also below expectations. But, I wonder if we bring this back to what we were talking about with Josh and Miles earlier today, because yes, we are seeing a big sell-off on the back of those results. But when you think about where GameStop is, fundamentally, you have to argue the story hasn't necessarily changed since we were talking about it as sort of a meme-ified stock. What is the strategy in place for this company's turnaround? But yet, Miles earlier talking about just how much we have seen a run-up in GameStop. So, this is obviously investors doing what they do, but just you have to wonder, is this just kind of a reaction to the run-up that we saw, this being brought down to earth with the numbers that we got? It's a bit of a reality check.
Yeah, because your question on the fundamentals, Akiko, is a good one. I mean, the bear thesis is kind of still the same on this, which is that the industry has fundamentally shifted. It's digital, it's streaming, it's subscription services, and they'll argue that these are just big, broad forces working against this name. And so maybe not surprised here. Also, by the way, we should note, I mean, it had already gotten hit pretty hard heading into this print. It was already down about 15% this year. It's down about 30% over the past 12 months, and now still heading lower here sharply in the after hours.
Now, the thing to watch here is, okay, we see a sell-off on the back of these results. Where does this stock go from here? We're talking about sort of just the exuberance that we've seen in the market. It's one of those stocks that have benefited on the back of that.
Yeah, for sure. We move on. Enthusiasm around AI has helped drive the market's gains thus far this year. As that momentum broadens, how are investment firms position themselves? We're joined now by Jeff Lewis, founder and managing partner at Bedrock. Jeff, it is great to see you on the show. And maybe we'll just start there, Jeff. We talk about the engines driving this market, and we talk about the economy and the Fed, but for sure also it's just all the excitement about AI, Jeff. I'm just curious, how you see that technology kind of evolving here, Jeff, in the near to intermediate term, and which are the sectors, the industries that you think are going to be disrupted?
Yeah, Josh, great to be here. I mean, I think we're in a really exciting moment. I think lots is being disrupted, everything from software engineering to medicine. We are major investors in OpenAI, and I do feel like they are at this point the sort of clear mega platform that is powering this wave in partnership with Microsoft. But in general, I just think it's a massive positive tailwind for technology broadly. You were talking a moment ago about GameStop. There's a sense in which that phenomenon back in 2021 was really powered by Reddit, and now it's sort of come full circle where you have Reddit surging 40% since IPO, and I think a lot of the enthusiasm around even Reddit is underpinned by what AI is going to be able to unlock for all of these technology platforms. So frankly, feeling very bullish on tech broadly because of, in large part, AI and what it promises over the years to come.
Jeff, let's talk specifically about OpenAI then. I mean, we've been talking so much about the exuberance around AI. Nvidia, obviously a big beneficiary on the back of that, but OpenAI is not a publicly traded company. And there's been a lot of debate about where this company goes from here, given the foundation of how it started, how it's now a for-profit company, that lawsuit coming through from Elon Musk recently. Where do you think OpenAI as a business moves from here?
Certainly. Well, as a starting point, I think lawsuits are always a really positive sign. And so when you have lots of different folks suing a company, as you have that with the case of OpenAI, publishers suing, you have Elon suing, that is just an incredibly positive sign. I think in the early days, Facebook had a lot of lawsuits as well. So, I say bring on the lawsuits with respect to OpenAI. I think that's a strong bull signal. The reality is this is a company that's really only been monetizing for just over a year. Predominantly with consumers. They've only recently launched offerings to enterprises. It's been publicly reported they're at north of a $2 billion revenue run rate. I just don't think we've ever seen in the private markets a revenue ramp that's been this rapid. And if you think about where private markets investors like myself were at, 7-8 months ago, there was a lot of questioning around, are some of these other LLMs going to really overtake OpenAI? The reality is they just haven't. And so if you look at the landscape of generative AI startups in the private markets today, the overwhelming majority of those companies are wrappers on GPT. So to me, OpenAI is at this point the clear winner. The revenue ramp, frankly, speaks for itself. And the partnership with Microsoft does give it several unfair advantages as they go to market with enterprises, expand the product offering. The stuff they're doing now, starting to work on now with Sora, partnerships with studios. I just think the range of markets that this company is going to impact is tremendously broad.
And Jeff, you mentioned how Musk is suing OpenAI, and his point seems to be, Jeff, I put time in here, I put money in here with the promise it was going to be open source. How do you think that fight plays out?
Well, no idea. I'm not a legal analyst, and certainly I would not ever want to be on the other side of a lawsuit with Elon. So it's hard to predict exactly what happens, but I think some stuff's been released, and it seems as if all folks, including Elon in the early days, all agreed that there had to be a for-profit type model. They had to raise significant financing in order to maintain their lead, and so I think when we're going to see where the facts come out, but I imagine that it'll be a prolonged, protracted lawsuit, and I don't quite know where it'll land, but I do think the meta point I'm trying to make is the lawsuits are a very positive sign. When something is powerfully working, folks come out of the woodwork and sue.
Jeff, finally, I do have to ask you about what's playing out with TikTok. Obviously, the Senate now taking up a bill that essentially calls for a spinoff of this company from its Chinese parent company. Let's say the spinoff does happen. It moves in that direction. Is this a company you'd invest in? Is it a good buy? I mean, you've got everybody from Steve Mnuchin to Kevin O'Leary saying, look, if we're able to separate it from the Chinese parent company, we want to buy in.
I don't think that we personally at Bedrock would be interested in doing it. It's a sort of the valuation will likely be extraordinarily high. And more importantly, my view on TikTok is that it's actually been very negative for society, just even beyond the CCP element with the control from ByteDance. If you spend any time with young children these days, they're just completely addicted to it. And I personally, we're at a point here as investors at Bedrock, we can invest in really whatever we want to, and we want to invest in things we think are making the world a little bit better. And I think TikTok is making the world a little bit worse. So not for me, but frankly, I don't even think they're going to be able to pull off the divestment. I mean, if you look at how long it took Elon to buy Twitter, that was 6 months plus with highly motivated buyers. It took Facebook 7 months to buy WhatsApp. I don't see how you can do a transaction this big in 6 months.
Yeah, which is why this bill has been characterized as an effective ban because of just how difficult that is. Jeff Lewis, Bedrock founder and managing partner. It's good to talk to you today. Appreciate the time.
My pleasure. Thank you.
Well, coming up, the Supreme Court signaling it's likely to reject a challenge to abortion pill access. We'll get you the latest on the other side. We'll be right back.
Is your guide, your group of advisors, planners, and jargon busters to help you save, build, and grow your money. How do I know if I'm saving enough for retirement? How do I know if it's right for me to go on that lavish vacation? Is it finally time to refinance my mortgage? How do I pay less in taxes? We'll get you the answers you need. Wealth, earning it, growing it, and managing it. It's more than tracking just the latest market moves. It's more than your favorite trending tickers. One does not simply build wealth without considering the entire financial landscape. It takes a community, and we've built one for you. Wealth cuts through the noise to help. Wealth on Yahoo Finance premieres March 25th.
Well, the Supreme Court signaling it will continue to allow access to the abortion pill. In a hearing today, almost 2 years since the controversial overturning of Roe v. Wade, the justices heard arguments and voiced some concerns on changing the current FDA rules on availability. The ruling could carry major stakes for both reproductive rights and legal drug disputes going forward, with the final decision expected to come as the election ramps up. Anjali Kamlani here to provide some context around this. What did we hear in these arguments today?
Yeah, so the justices did pose a lot of not just legal, but also medical procedure questions for the lawyers, and looking at what exactly the banning of mifepristone, one of the 2 drugs used for medically induced abortions, would result in. Now, they did give some indication that they thought, it was unnecessary to go on a full nationwide ban, but we've seen this case really move up into the courts, and quite quickly, I might add, in the past year or so. So what we saw was, first of all, mifepristone approved back in 2000, and that was the first time that it came on the market. You then saw mail order access come up in 2021 because of the pandemic. Now, as a result, or after that rather, is when we started seeing this pushback. Back in last year is when the federal district court saw that pushback, that halting of the approval. Meanwhile, the question of the mail order was also up, and that has also been questioned and could have been put on hold as well. Now we've seen the arguments before the Supreme Court. No final decision just yet, but based on those questions, it does look like they are likely to go against it. Questions like, why can't doctors just decide not to approve or prescribe these drugs for anyone who comes looking for them? There's also talk about looking at using an older law called the Comstock Act, which disallowed basically lewd, if you will, materials to be included in the mail, including things that are quote unquote used for abortion, for producing for abortion. And so, there's so many different arguments for this. There's also the question about the FDA and whether or not it's quote unquote infallible, which has been one of the arguments. And so there's so many different reasons why we are keeping track of this. As you indicated, Kiko, a lot of implications moving forward. So while it looks like they have some potential indication of possibly not supporting this ban, we will all be waiting to see.
All right. Thank you, Anj. Appreciate it. That'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.